From the bustling markets of medieval European city-states to today's digital global economy, one thing remains constant: the need for a dominant currency to facilitate trade. The US dollar has been that unifying force for decades, acting as the world's financial linchpin, but whispers of change are in the air. Today, we'll journey through the intricate dance of currencies, explore why the greenback has been the go-to for so long, and uncover the emerging trends that hint at a future where the dollar might not stand alone. Are we on the brink of a financial revolution? Let's dive in and find out. The US dollar and the cycle of exchange. The US dollar's dominance in global trade is not merely a result of the US being the world's largest economy. Its significance is further amplified because vital commodities, especially oil, are priced in the dollar. This has made the greenback a universal language of value, facilitating economic transactions across nations. But this wasn't always the case. The journey of dominant currencies from medieval European city-states to today's global economy is a testament to their power, the networks they foster, and the trust they command. Let's delve into the intricacies of currency exchange. Consider an American wanting to purchase a British product. They'd need British pounds. The most straightforward method would be finding a Briton wishing to buy something from America, requiring US dollars. This cycle of currency exchange is the essence of international trade. Each currency, whether it's the dollar, pound, Swedish krona, or Samoan tala, represents a value that can be exchanged for goods and services. However, not all currencies are exchanged with the same ease. For instance, while the Swedish krona and the Samoan tala hold value, they aren't frequently exchanged due to limited trade between Sweden and Samoa. The rarity of a Swede seeking Samoan talus, or vice versa, creates an exchange barrier. But there's a workaround. With substantial trade between Samoa and the US, a Samoan can easily convert talus into dollars. And given the significant trade volume between the US and Sweden, converting those dollars into krona becomes a breeze. This indirect transaction via the US dollar is quicker and likely more cost-effective. With 180 UN recognized currencies, the potential combinations for currency exchange are vast. Yet, finding a direct trading partner isn't always feasible. This is where the US dollar steps in, bridging 88% of currency transactions. It doesn't imply that these transactions are directly related to the US dollar. Instead, the dollar's ubiquity makes it a preferred medium for international transactions. It's a cyclical phenomenon. The most traded currency is the easiest to trade with, reinforcing its dominance. Historical context of dominant currencies. Throughout the evolution of global trade, there's always been a currency that stands out, making transactions smoother and more efficient. The US dollar in recent history has played this role. Its widespread acceptance isn't necessarily because everyone wants to transact in dollars, but because it's the most convenient option. But let's take a step back. The US dollar wasn't always the go-to currency. In earlier times, the Venetian ducat, the Spanish real, and the Dutch guilder held these coveted positions. Their dominance was attributed to their stability and reliability, making them the preferred tools in their respective eras' trade networks. Consider the Mediterranean city-states of Venice and Florence. They introduced the ducat and the florin, respectively. Both coins, made of gold and almost identical in weight, became widely accepted across the Byzantine and Holy Roman Empires from the 13th to the 16th centuries. Their widespread use wasn't due to any forceful imposition by Venice or Florence. Instead, these coins held their value consistently, were trusted, and were easily accessible due to the expansive trade networks of their originating cities. Whether it was a Genoan boatmaker securing funds or a Venetian merchant trading salt, transactions often occurred in ducats or florins. These coins became the common currency, trusted and used by both parties in a transaction. As trade routes shifted from the Mediterranean to the Atlantic, the world's economic hub moved westward to the Iberian Peninsula. The discovery of vast silver reserves in present-day Bolivia ensured the Spanish real's rise as the new dominant global currency. This silver influx made the real the most accessible and reliable option for worldwide commercial transactions. In North America, for instance, the Spanish dollar remained popular throughout the 1700s, not because of any loyalty to Spain, but simply because of its convenience. However, Europe soon saw another shift. The Dutch introduced the guilder, backed by the world's first central bank and a powerful trade network. Its stability and ease of transaction made it so popular that by the mid-18th century, an estimated 85% of European banks accepted it for settlements. Historically, the dominant currency has often been that of the world's leading empire, chosen for its reach and stability. These currencies became the de facto reserve currency, held by banks and businesses to ease international transactions. The British pound sterling, for instance, benefited from the British Empire's territorial expansion and the Industrial Revolution. By 1900, it accounted for 62% of the world's reserve currency. However, its reign was short-lived. Post-World War II, with the US holding a significant portion of the world's gold, the US dollar emerged as the new dominant currency. Currency in the modern era: dollars, sanctions, and geopolitics. The evolution of nation-states, central banks, and paper currency has solidified the idea of a dominant global currency. Historically, the pound sterling held this role, only to be succeeded by the US dollar. This dominant position of the US dollar in international transactions has given the United States significant leverage in the global financial arena. Modern geopolitics has seen a shift towards economic warfare, primarily through sanctions. The US dollar's pivotal role in global finance allows the US to wield considerable influence. For instance, when the US imposes a sanction, it essentially becomes a global sanction due to the dollar's ubiquity in international transactions. This was evident when trade between the European Union and Iran plummeted by 92.8% between 2018 and 2019, despite it being legal, simply because of the challenges of avoiding US banks, companies, or the dollar. The recent geopolitical tensions, particularly Russia's unprovoked invasion of Ukraine, brought this power dynamic into sharp focus. Instead of resorting to military action, the West opted for economic warfare, primarily targeting Russia. The US, leveraging its financial might, was able to freeze or seize approximately $330 billion of Russian assets, both domestically and internationally. The reach of the US was so extensive that assets like a $300 million yacht owned by a Russian oligarch in Fiji were seized due to its financial ties to the American system. While the sanctions against Russia were largely uncontested, the sheer power and reach of the US in enforcing these sanctions raised eyebrows. Nations began to question the wisdom of allowing one country such immense economic power. This debate isn't just about the sanctions themselves, but the broader implications of having such a potent economic tool at the disposal of a single nation. Russia, out of necessity, sought ways to bypass these sanctions. China, a significant global player, stepped in to assist. The trading volume between the Russian ruble and the Chinese yuan surged as China offered its financial system to facilitate Russian transactions. This move wasn't spontaneous. China has been working since 2010 to position the yuan as an alternative to the dollar. By 2020, China and Russia had reduced their dollar-dependent trade from 94% to a mere 23%. Instead of using dollars for oil transactions, China began paying Russia directly in yuan. This trend of moving away from the dollar isn't limited to Russia and China. Countries like Argentina and Brazil have also started trading with China in yuan to protect their dollar reserves. Furthermore, the BRICS nations, Brazil, Russia, India, China, and South Africa, are not just fast-growing economies anymore. They've evolved into an influential intergovernmental organization, seen by many as a counterpart to the G7. One of their significant discussions is the creation of a new international currency for trade, independent of the dollar. The US dollar's dominance is being challenged, not just due to geopolitical tensions, but also because nations are seeking more balanced and equitable financial systems. The future might see a more diversified global currency landscape, reducing the concentration of power and offering alternative systems for international trade. US dollar vs Chinese yuan. The global financial landscape is undergoing a subtle shift. One of the primary reasons for this shift is the perceived negative impact of a strong US dollar on the global economy. A robust dollar can exert pressure on other countries' external sectors. While the US dollar still holds a significant share in global forex reserves, its dominance has waned over the years. The US dollar made up 58.36% of global foreign exchange reserves as of the last reported quarter. In contrast, the Chinese yuan, though still a minor player, accounted for 2.7%. China's role in this evolving narrative is pivotal. China's influence is undeniable as the world's second-largest economy and a dominant force in global trade. Recent data reveals that mainland China stands as the primary trading partner for 61 countries, overshadowing the US, which holds that position for 30 countries. This growing economic clout means China is poised to exert even more influence in global financial institutions and trade. However, China's rise in the global financial scene is not without its challenges. Despite its economic prowess, China has been reducing its holdings of U.S. Treasury securities, reaching a 12-year low. This reduction is not an isolated move. Other nations, like Brazil and Malaysia, have also expressed their desire to reduce their reliance on the U.S. dollar. Proposals like the Asian Monetary Fund and settlements in local currencies are gaining traction, indicating a broader sentiment against dollar dependency. But why the Chinese yuan? Trading in local currencies offers several advantages. It provides businesses with more certainty about revenues and sales, balances risks, and offers more investment options. Moreover, moving away from the US dollar in bilateral trade can help countries ascend the value chain, shifting from merely selling products to establishing bilateral trade blocs. Yet, the journey for the yuan to become a dominant global currency is fraught with hurdles. China's unique economic system, characterized by significant restrictions on capital movement, poses challenges. For instance, individuals face limits on sending money abroad, and there are substantial constraints on foreign access to Chinese financial markets. In contrast, the US dollar enjoys unparalleled openness, with minimal restrictions on its movement, making it a preferred choice for international transactions. However, two potential scenarios could challenge the US dollar's supremacy. The first is a massive economic collapse in the US, leading to a loss of confidence in the dollar. The second, and more contemporary, is the weaponization of the dollar. If the international community perceives that the US is misusing its dollar dominance in global affairs, it could lead to a consensus-driven move away from the currency. Conclusion: while the US dollar has historically been the linchpin of global trade, the winds of change are stirring. As countries explore alternatives and the dynamics of global finance evolve, the once unquestioned dominance of the dollar is being challenged. From the rise of the Chinese yuan to geopolitical tensions influencing currency choices, the landscape of international trade is shifting. As history has shown, no currency's reign is eternal. The future may see a more diversified global currency landscape, reflecting a world that's moving towards multipolarity and seeking balance in economic power.